a big part of it is independence and rules and all that kind of stuff. And this is actually a big chunk of the test too, the CPA exam. Chapters 6 and 7 are a pretty big chunk of it. This is probably like 20% or something. This is probably also like around 20%, somewhere in there. Yeah, which is a little bit surprising, the professional standards, because you would think that they'd be a little less than that, but they really get into the professional standards on it. So anyway, this is what I have this saved as. We do have it saved. Okay, so let's go ahead. Any question, anything? All right, let's go ahead and jump into. I did not that. All right, and I think we're close to done with this one. We're on 8. Yep. Okay, so number 8. I think I'm gonna move this. This is on page 6. Well, actually, I'm not sure it's on page 6 because my spacing will be all out. But number 8. Now you guys can find it here. Graduate students, I don't know why I'm doing this. All right, communication of internal control. Let me change this a little bit. All significant and all significant and material deficiencies in internal control must be reported Okay, now I know these are kind of vague terms, but all significant and material deficiencies in internal control must be reported in writing to management and the board of directors. And within 60 days. So if you come across a significant or material deficiency in internal control, it must be reported to management and the board of directors and audit committee. That's not optional. You must report it to both of them. So if it's significant or material, the actual wording of this rule is that any significant deficiency, significant is less than material. So by definition, material is significant. Right. And so, it's one of those things that when they talk about significant deficiencies, that also includes material deficiencies. So the actual rules are about significant deficiencies, but which include material deficiencies. They usually state it just like I put it up here, though. Significant and material deficiency in internal control must be reported in writing and management board of directors within 60 days. Insignificant Deficiencies in internal control. Let's be reported to management. So insignificant deficiencies reported to management. In other words, you don't bother the oversight people, the board of directors or audit committee. So if it's insignificant, if it's not, if it's not going to make a difference one way or another for the financial reporting. Now, for PCAOB, they must. You don't have to report all the deficiencies in it, but they must be made aware. And basically what you're doing with that is you're telling them, look, there's insignificant deficiencies that are reported to management. So they're aware that there are insignificant deficiencies reported to management, that they're aware. If they want to follow up on it, they can. But you don't go into detail on those. And part of the reason why you don't go into detail, for instance, for the AICPA, when they just say, you just report to management. One thing I'll tell you about board of directors is that a lot of times they're not all savvy, especially on internal controls. And you don't want them getting sidelined for something that is, clearly insignificant and ignoring something that's very, that's very important. So generally you give them, okay, this is the important stuff. The stuff that's not important, we're going to give it to somebody else. And PCAOB says, we'll tell them about that you gave it to them. But, the idea is that you don't bother them with insignificant things. If for no other reason, you don't want them focusing on those things. Focus on only those things that are material or significant, I should say. So significant and material deficiencies in internal controls we heard right now. Okay. On a financial audit, significant and material deficiencies are not reported. Why? Because the financial statements may be fine. We talked about before that if you have a material misstatement, scratch that. If you have material weakness, doesn't necessarily mean that the financial statements are misstated. If you have some people that aren't following the rules or whatever for internal control, it doesn't necessarily mean that the financial statements are misstated. So you're not going to put that in the financial statement because the financial statements may be fine. And if the financial statements are fairly presented and not materially misstated, they get a clean audit, even if they do have material deficiencies in internal control. Okay, now, this it probably goes without saying, but if it's an internal control audit, And this could be through the PCAOB, which is probably the most common one, or ACCT433. I should say is are not included in the audit report. Okay, if it's an internal control audit, as you may expect, they are reported because you're reporting on the internal controls. Okay, so significant material deficiencies. Financial audit, they are not reported because the financial statements may be fine. Internal control audit, you're actually doing an audit on the internal control. So if there's a material deficiency there, significant or material, actually the only material, that it would be included. Let me change this. This is usually for material only. So material deficiencies, kind of like material misstatements. These would be similar to material misstatements in the financial reporting. And there is no AICPS, that's AICPA. Okay. One of the things that we talk about is for testing is timing. And a number of things are dependent on timing. For instance, the inventory. Purchases cut off. So these are all things that are basically done at a specific time, usually at year end. Okay. the client has good internal controls, you can do interim testing throughout the year, and for larger companies, that's very common. They've got, if you ever watch them do, if you ever go into like a Walmart that's open 24 hours or something like that, if you go in late, you'll see people taking inventory a lot of times. They'll have an aisle blocked off and a bunch of tags on it, and they'll be doing an inventory. And that's very common. And as an auditor, you'll have to go observe those. Every now and then they'll say, go observe this inventory at 11 o'clock at night at Walmart or whatever. So the interim testing days. So a lot of times they won't actually do the inventory completely at year end. They may make adjustments and they may have some special things they look at, but for the most part, that'll be done throughout the year. And generally, it's required that they would do the entire inventory in an annual cycle. In other words, even though you don't do it at the same time at year end, that everything gets tested, inventory gets counted basically throughout the entire year. So that's nice because then it takes some of the pressure off the ending inventory. While it's still important, a lot of times that can be done ahead of time. And if you think about it, why wait till December 31st if you can get 10 months done, test up through October, say, before the year end. If you can get 10 months of for instance, revenue testing and that sort of thing done, you may as well do it. Okay, so the testing. Low detection risk means low detection risk means that you're going to audit to a risk that is low. The detection risk is a risk that the auditors, I should probably write that in, what detection risk is. That would maybe make some nice little reading right now. Let me go to the next page. So detection risk is a risk that auditor will fail to identify a material misstatement. Now, if they set that low, that means that they're really looking at it. And usually that's for riskier clients. Setting a very low detection risk, it could come about from other situations too. It could come about that they're not testing the internal controls or they have no confidence in the internal controls. But everything else being equal, low detection risk means usually a riskier client. That if you have a client that is whatever, they're in a volatile market, they're doing poorly, they're facing bankruptcy or something like that, you lower that detection risk, because you're looking for things. It's more likely that something will happen. High detection risk means that you're not as worried about the client usually. And not that they won't, the companies that are doing well. Already covered interim testing. So the detection risk, they kind of go almost, when it comes to the testing itself, kind of goes in opposite directions. The lower the risk, the more the testing. And usually that's for riskier clients. If you have a client that's doing well, low risk, maybe they don't have a lot of crazy things going on, you can back off on some of the detection risk. And if they are a safer client and there's less risk, people say, well, why don't you just do more testing for both of them? Why don't you, even if it's a good client, why don't you do the reason being is that you have to also have to keep in mind, you don't want to waste the client's money. That's not, why audit to the 99% level for a client that could, you could easily be, satisfied with a 95% level. Why do all that extra testing if it's not really going to add anything to the audit? And in the end, I mean, you basically bill a client, so you'd be also kind of wasting their money. Okay, well, system organization and controls. Service organizations are, well, they provide services. And that's what these are basically for. And I think I talked about this before, and that is, for instance, well, let me give you an example of the services. So for instance, you may have payroll done by ADP. Electronic or e-commerce done by Amazon or Walmart. So maybe you have a client that has a presence on Amazon or Walmart. They're selling stuff there. And they could have internet services, they have cloud services, they could have all this. There's many things that could be service organizations. It can be banks. Banks can have a lockbox service. There's all kinds of things that could be a service organization. And these are things that the companies don't do themselves. Now, just because they don't do them doesn't mean that as an auditor, you don't have to get some sort of understanding and comfort that these things are being done effectively, that the controls are effective. For instance, the payroll. Let's take the payroll. Just because the company doesn't do the payroll themselves doesn't mean you're off the hook. You still have to be able to sign off on the audit report saying that, free of material misstatements. Payroll services are probably material. So you are going to have to get some kind of comfort that those payroll services are done correctly. They have the controls in place, the same controls that you'd have if the client was doing the payroll themselves. So how do you do that? Well, you can't simply have, if ADP is doing the payroll for 5,000 clients, you can't have, 5,000 groups of auditors walking through ADP doing testing. It's just not practical, obviously. So in lieu of that, they issue reports. They do have an audit report that's specifically for their internal controls. So they have an audit report on their internal controls, and that is what you will rely upon when you get that report, depending on what the report has in it, obviously. But that's what you'll rely on as your documentation of the internal controls. That you'll be relying on another audit by somebody else, most likely, a different. Even if it's your same firm, it'll be somebody else doing that report. Okay, and these come in 3 flavors: SOC 1, SOC 2, and SOC 3. All right, SOC 1. These are the ones that mostly they talk about for auditing of financial statements. This is only for financial reporting. It's only for the numbers, basically. So the SOC 1 is reporting on the internal controls, but only for the financial reporting part. By the way, these SOC 1, SOC 2, and SOC 3, these are all trademarked by AICPA. They actually have their definitions and so on, and testing and all that kind of stuff it's all trademarked. But so the SOC 1 report will give you, if you're auditing, say, payroll, and they'll have you get the SOC 1 report from ADP, and that's what you will use as your in lieu of you doing that testing yourself. That someone else did that testing, and you'll take their report. And as long as they're reputable and you can rely on them, which usually they would be, you're fine with it. Oh, I got an example here. It's the same boring example I just said. Okay. There's two types of reports, and this kind of carries through all three of the different SOC 1, SOC 2, and SOC 3. Type 1 is that the design of the controls are evaluated. It's sort of like getting an understanding, is one way to think about it. So the design of the controls are evaluated. So they look at the controls and say, okay, are these designed correctly? All right, so a type 1 is sort of like getting an understanding of the internal controls. Excuse me. Type 2 is where you not only look at the design of the internal controls, but you also do testing to see if they're operating effectiveness of the controls. So this is a higher level. So if you're looking at a report of SOC 1, you're probably going to want to see a SOC 1 type 2 for the most part, unless it's not a very important part of the business. You're probably going to want to see a type 2. So type 2 is where they not only look at the design, but they also look at testing. So they're doing some testing, say, okay, we know you have a design, let's check and make sure that this is functioning the way it's supposed to be. And so you actually do testing. So type 1, no control testing, you look at the design only. Type 2, testing control. And I should say you also look at the design of it on that too. Okay, now SOC 2, these are more extensive. These are usually used not by the external auditors, although they probably can be. These will have virtually everything in it. Not just are the financial statements, free of material misstatement, but are the employees, how is their information guarded from hackers? How is all those controls that are really not financial necessarily for the financial reporting, but those controls that go beyond that and that are over the whole service. And this is usually used by people that are trying to decide whether to use a service. If they're looking at ADP, they might say, well, let's see your SOC 2 report, because we're trying to figure out if we should do this or not, because we don't want our employees, we don't want to give ADP our employees, and then all of a sudden all our employees have all their stuff all over the internet, and they're having stolen identities and all that kind of stuff. So a SOC 2 is a more detailed report. A lot more goes into it. They don't just look at financial reporting. They look at virtually every aspect you can think of what what companies do to secure the data and their controls over things that are not financial, basically. And the external auditors probably could use this report, but will have a whole bunch of stuff in there that they don't need. Anyway, this is same as before. Type 1, no control testing. Type 2, testing the controls. And so this would be, but this is a much more extensive report. This is a really detailed report. Both SOC 1 and SOC 2 are not for the general public. They're too detailed, and they actually have classes basically on how to read these things. So SOC 1 and SOC 2 are not for the general public. Those are for business people only. SOC 1 is usually for the auditors. It could be used for other things too, but SOC 1 is for the auditors, and SOC 2 is usually for decision makers and people who know internal controls and those sort of things are the ones that are going to be looking at those. It's a very detailed report. Now, So you say, well, what about the general public? Well, you know, what you tell your employees we're going to be using ADP, and the employees say, well, I don't know, are they secure? Why are we, why are we using them? What can we? That's what a SOC3 report is. A SOC3 report is generally formatted in an easy to understand format that anyone can read it. So if someone, if you decide to go with ADP, you ask them for a SOC3 report, and the SOC3 report will basically tell them exactly, the stuff that how do they predict their data and all that sort of thing. But it'll be done in a much more, and not a detailed way. And it's not a detailed report. It's going to be kind of broad strokes as far as what they do and to predict data and all that kind of stuff. So the SOC3 is for anyone. Probably wouldn't be used by management. It could be, but usually this is for, like you say, the general public, and so that you can let somebody know whether or not the about how their data is going to be protected and all that kind of stuff. And again, there's no technical terms for the internal control stuff. They're not going to. It's not detailed. So those are audits of internal controls, but those are for service organizations. Okay. Auditing internal controls for the PCAOB. So this is for issuers. Issuers must have an audit of their internal controls. They'll have two audit reports. They'll have an audit report on the financial statements. They'll have an audit report on internal controls. I'll tell you, this is kind of a humorous side note. When they came up with the Sarbanes-Oxley Act, the people who wrote it up were kind of thought or led to believe or whatever that the better companies were all doing this, that the better companies were all evaluating their internal controls every year and all that. And what they found out was no one was. And if you think about it, how much does General Motor make on evaluating their internal controls? Nothing, right? So a lot of times these things that they probably should have been doing, they're not. They don't make money evaluating internal controls. They make money selling cars or whatever. So a lot of stuff like this would get pushed. It may have gotten pushed down in the past. And so now, when the Sarbanes-Oxley Act came, it said, okay, well, they have to do this. So the things that you must do for to examine their internal control, and this is every company. Management must accept responsibility for the entity's internal control. So management will actually sign off saying that they are responsible for it. They will evaluate the effectiveness of it. So it's an evaluation by management of the effectiveness of the internal control. So they will evaluate it, and there's all kind. CPA firms made billions on this because all these companies didn't know how to, what do they need to evaluate the effectiveness and how they do it, and all these companies were consulting them. CPA companies love Sarbanes-Oxley Act. It gave them a lot of business. So anyway, management must evaluate the effectiveness of internal control. So they will basically have to back up their internal control. What they came up with. Let's undo that. And let me back it up down here. Management must get sufficient appropriate evidence, and that is very familiar. That's the same thing that we have to do when we do our audit report. But this is management. So management accepts responsibility. They evaluate their effectiveness of the internal control, and they must have sufficient appropriate evidence to back it up, testing and that sort of thing to back up their assertion, and that's basically what it is down here. So it's similar to what we do as an audit. And so now this is management. This is not the CPA firm. So the management must do this. And basically the auditors come in and do an evaluation of management's assertion. So when management comes up with an assertion, auditors come in, they'll look at the appropriate evidence, see if they have enough evidence. They'll do some testing of their own, test the controls, especially if they didn't test those controls for the financial audit. But they'll basically give a report on saying whether this management assessment, their assertion is reliable. Okay, so it's basically on management to do all these things. And again, nobody was doing this before Sarbanes-Oxley. Okay, indicators of material weakness. And these are some of the ones that are sort of obvious. And by the way, this is one reason why, which one do I have? Plenty of room. If you look at these things, this is why the auditors of client's internal controls must also perform a financial audit. The question comes up, well, okay, why doesn't, why don't we have different groups? Why we have an auditor, the client's internal controls, also perform the financial audit. Well, why don't we just have a different audit firm come in and do the internal controls? There could be people that are specialized in financial audits and people that are specialized in internal control audits. Why not do that? Well, there's a good reason why. And that's when you're doing the financial audit, you'll become more aware of those controls that affect the material misstatement. And so these are things that would indicate that there's a problem with internal controls. Fraud involving senior management, that one would be fairly obvious. But this one down here is, let's make this. Identification of material misstatement during the financial audit that was not detected by internal control. So if you're doing a financial audit and there was a problem with internal control, okay, that's obviously a good indication that there's something wrong with the internal controls. So, one of the main reasons why you have to do the audit is because you'd be looking at those things that do affect material misstatements, where that might be a little bit lost if you just did the an audit of internal controls. This is sort of more direct. Yeah, so seeing those are kind of things that they. I already talked about this. I didn't talk about this. 3 is very important. Let's look at 3. The auditor should not ever, I left that part out, issue any reporting that states that no material weaknesses or no significant deficiencies exist. This comes up, they usually have a few, CPA reviews, they'll have a few questions on that. you cannot say in a report that no material weaknesses exist, or that no significant deficiencies exist, or that, you know, or anything to those, or even that, you know, that's all, that you didn't find any. You don't give any assurance on that, because remember that we have the reasonable assurance. And so you cannot say they have no material weakness. And they may want you to do it. Can you tell our bank that we have no material weaknesses? Because, you know, that would, you know, just write it down that, you know, we have no material weaknesses, and I give that to the bank. You can't do that. All right. So you can't do that. And you also can't say that no significant deficiencies were identified in the audit. And if you think about it, truthfully, you're not looking for deficiencies that are merely significant. You're looking for things that are material. So even you might find significant deficiencies, but truthfully, that's not really what you're looking for. And so one of the things about significant deficiencies is that you weren't even looking for them. So you'd never say that you didn't find any significant deficiencies because you weren't looking for significant deficiencies. And that may, if you said you didn't find any, that may indicate, or somebody may assume that means you were looking for them. So again, you cannot make any statement that the company doesn't have any material weaknesses or significant deficiencies. Okay. This is the ugliest part of internal audit now, and I'll talk about it a little bit. The Committee on Sponsoring Organizations of the Treadway Commission. Also, this is basically known as CASO. And if you're taking the CPA exam, there's going to be CASO, and there's also going to be CASO ERM. When it comes to internal control, the idea was, look, you have all these different organizations that are defining internal control, and they're all different. And so the question is, well, you know, wouldn't it make more sense if this was a comprehensive thing? That if you had a comprehensive statements on internal control, so you didn't have all these different groups making up their own, you know, very narrow definitions of internal control, that you would have an overall one, and you'd have experts in internal control that would know all these internal controls and all that kind of stuff. And so that's where this CASO, this sponsoring organization, so this is the all these groups getting together and working through kind of the general outlines and so forth of internal control. Again, this is not just for accounting or for auditing. This is for many groups and, you know, all these different organizations. So there is stuff in there that is not really geared towards us doing financial audits or even us doing internal control of companies. There could be other things in there too. So let me go back to this. So these are the groups that they kind of got together and said, okay, we will put together a comprehensive group of internal controls. And this is basically the core of those. Okay, don't do the underline. So these are basically the control, is the different components of internal control. Okay, so these are the 5 categories. Now I'm going to show you something that looks very confusing, and this is one of the things that you'll see all the time is this is the cube. The cube, which looks incredibly confusing. Oops. but it's really, try to get the cube on one page. Okay, so this is the cube, and you'll notice that we have the five different components of the framework are in here. Control environment, risk assessment. We'll get through these in a second. Control activities, information, and monitoring. Now up here, you'll look at these. These are actually the three different types of audits. Operational audit. This is to make more effective and efficient. Reporting. That's what we do, right? So this is the internal controls over reporting. And compliance with the IRS code, compliance with government contracts or government grants or whatever. So you have compliance audits, financial audits, and operational audits, which are basically, effectiveness and efficiency of operations. So if you think about it, it's okay, these are all the different areas, and then these are the three different types of auditing that you usually see. Now, you look at this thing on the side here and go, okay, well, what's this? This is just the different levels of the organization. This is the upper level, entity level, down to the division, operating unit, and function. So this is going, starting at the top, the control environment, for instance, over operating, blah, 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 at the top, control environment at the division level, for these three different types of, and so on and so forth. So really it is, these are the five categories. These are the different types of audits. And this one, which I actually think is kind of annoying, but this one, that's just my aside. That's not the CPA exam. It's just it says basically for all the levels of the company, the upper level, middle level, operating levels, and the specific function level, all that kind of stuff. So it's really still those, but is these five categories are really what you really focus on for the CASO. All right. So, and we're not even going to go through all these. Control environment. A lot of times it's kind of called the tone at the top thing. And that they have a commitment to integrity and values. And they have effective oversight by the board of directors. And these are just some of the things. And basically the idea is whatever is important to the people up at the upper level of a company, the people, the rest of the company will follow. So if you have good people at the top that believe in all these things, then the rest of the company will follow. If you don't, if you have bad people at the top, the whole company, if they don't care about internal controls at the top, they're not going to care at the bottom. Okay. Risk assessment. And this is one of the things that companies were not doing, but now they have to under Sarbanes-Oxley. And that is that they will have to actually go through and see whether they're, where the risks are for their internal controls. And this is specific on the objectives of the company. And the objectives could be for reporting, objectives could be for compliance, the objectives could be for the efficiency of the company or the effectiveness of the internal controls and all that kind of stuff. So they have to do a risk assessment. So tone at the top, risk assessment. All companies must do this now. The specific control activities. These are things that go through, how do they actually, what do you actually do for control activities? This is PIPs. I think they actually changed this now. I forgot what the A is. Because now it's PAPIs. So anyway, But what will we use? I think that these are the only ones that are in that in the CASO, I believe. Performance reviews. These are not employee reviews. These are usually independent checks and management review controls. So what we're talking about there is, for instance, bank reconciliations. Bank reconciliation is a review. You're reviewing it. Independent checks and management review controls. It could also be things like budgeting. If something material comes through, it'll hit somebody's budget and they'll get mad. And that's a review of what's going on in the company. So performance reviews, we're not really talking about necessarily like for employee reviews. We're more looking at all kinds of reviews of actually activities in the company. Information processing controls, which are pretty obvious. So information processing, who has access to the computer system, what access level do they have, who has access to the data, that's a big one, the data access. All those controls over processing. Physical controls. Do they have guards? Guards out front. That's always a good physical control. A key card to get into the place. That's a physical control. You don't let just anybody walk into not only the building, but certain place. If you have a bank, who can go into the vault? There's no reason for everyone to go in the vault. So you have physical controls keeping people from doing that. And segregation of duties, which we talked about. That's CAR, and that is custody of assets, authorization, and record keeping. I drew a blank on what accountants do. Okay, so anyway, you remember that by PIPs, and that's sort of these are the control activities that you usually see, and most activities can be put in the. I forget what they put for the A. The new there's an A for the someone has an A on the new one. Okay, information and communication, and one of those things is that they actually generate that there's feedback. There's actually something relevant that comes out of the information that's generated by these control activities. So the control activities will actually generate information that management can use to monitor and to use it more conclusively to do other things with it. And down here, the monitoring, and that is to see if the controls are working, and it's sort of like a loop. Is this working well or not? Are these controls working? And the monitoring of the controls is not monitoring of the data; it's monitoring of the controls themselves. So this would be monitoring of the data. This is for data. What data do we get from these internal controls? How many people access this building? Who accesses the building? All that kind of stuff. The monitoring of the controls are the controls themselves. Are these controls actually working? Are we picking up everybody that I was in the warehouse and I saw Janet was in the warehouse, and I looked through the data and it doesn't show that Janet was in the warehouse. How did Janet get into the warehouse without us knowing about it? And if Janet can get in, Janet might be a fine person, but if Janet can get in without anyone knowing, maybe other people can too. So we may have to revise the controls. So monitoring of the controls themselves, this is actually, you might change the controls that you're actually using and relying on. So it's sort of a loop that you make the controls, you get the information, the data, and then you also check to make sure that those controls are actually doing what you hope they do or what you think they're doing. Okay, and down here we already talked about this. The different levels, the different CASO level. I probably should have talked about this earlier, but for instance, General Motors at the entity level, a divisional level, maybe they have auto manufacturing. General Motors might do other things. They used to do, I don't know if they still do, they used to have a locomotive service. They used to have financing arm. They used to have all these different things that they would do, generators and military contracts and all kinds of stuff. But a division might be auto manufacturing. That's probably what we most associate with it. You know, we usually don't buy tanks or something, you know. So we probably are looking at the automotive. You know, we can think about General Motors probably. And operational unit B, so for instance, the Buick unit and function auto assembly plant in Wisconsin. You know, and the idea is that these control activities will be at all levels for all the different types of kind of auditing that they would do. Question on that? And that CASO is getting more and more important on the CPA exam. When it first came out, you know, the reviews, they'd have 2 questions on it. And then it got to be 5 questions, and it got to be 30 questions, and you know, in a simulation or whatever. But anyway, that is becoming more and more relied upon, the CASO. And the CASO ERM, the ERM is for resource management. I forget what the E is for. Executive resource management. Well, I don't know what it is, but the ERM it has a few extra things tagged on there. But for the internal controls, it's still.
Is it resource management or risk management?
You know, you're right. Entity risk management.
I think I had to study this.
Yeah, entity risk management is you're absolutely right.
Yeah, enterprise. It's on the top of number 12, frameworks and guidance on enterprise.
Oh, did I? Yeah.
Is that correct? I think so.
I don't
know. Number 12. You're almost there.
Oh, yeah. Yeah, they usually call it CASO ERM. And the idea is they do, well, you know, here's a risk assessment process that they have it. And it, I'll have to look it up. I think they've added, I'll look up the framework, but, and quite honestly, I mean, this isn't the kind of thing you get to know every day. This is more of the kind of thing you would study for the CPA exam. But it is becoming more and more the way they're going, and part of it is because, you know, and this is one of the things that's true about the AICPA as any organization. The stuff that they deem as important, like this, is the stuff that they're more likely going to test on. You know, they're probably more likely to test on this type of definition of internal control, partly because they're a part of it. So, okay, well, that's it for that. And I think I'm just going to send out, I'll send out a, I'll send out a test. And but I know that we haven't really done any problems with this, and I don't think we're going to. But there's quite a bit. I think you guys should be fine. If you know, I'm not gonna. You know, oh, here it is. PAPIs. Oh, authorization of transactions. So PIPs was one I just showed you, but authorization of transactions. That was. I think they used to be included in information processing or something like that, most likely. Well, actually, it's in segregation of duties too. Authorization. So they pull authorization from segregation of duties and put it in here. I'm not sure why they did that. But it's authorization of transactions is in segregation of duties. All right. Yeah. So I'll put something together and send that out. And again, it'll be it'll come out of most of the other stuff. And by the way, this is a good chunk of what you'll see in the taking the CPA review. It's kind of condensed, and but that's basically what you're gonna be looking at. Okay, let's go ahead and take a break. What time do we have? 6. Let's say be back at let's say 7:10. If you come back a little later, that's fine. So let's go ahead and so we'll be back at 7:10, and we will start in on chapter 19, and that is professional responsibilities, basically integrity, internal controls, professional practice, and all that kind of stuff. Not internal controls, independence, and that's also fairly heavily tested on the CPA. So, okay, well, let's go ahead and take a break, and we will start in on next one. Okay. Hello. I'm back. Well, first of all, Jason, I just looked outside and we have blue skies out here. So you're getting pounded by snow. So what we're going to do next is the chapter 19 stuff on independence. It's heavily tested on the exam. My personal opinion, it may be too tested on it, make it more important than it really is. But anyway, let's go ahead and share my screen. Nope, not that. Nope, not that. Okay. A big thing that they cover is independence. Oh, I know what I got. Oops. I'll do this in a second. All right. And independence, obviously, they have to be independent. The idea is that, well, first of all, the report's called the Independent Auditor's Report. So as you can imagine, that means independent. And the reason for being independent is that it gives is that you be unbiased. And you have to be independent in appearance and in fact. And what they mean by that is you might be independent in fact, but it might appear that you are not independent, and that's also bad. The only thing that we give financial statements are credibility. The only auditing gives financial statements is credibility, and anything that diminishes that credibility is not helpful. You know, the only thing audit gives is credibility, and if it doesn't give credibility, it's worthless. So independence is a big thing for the AICPA. As it is for any group that is trying to, you know, if you're trying to be unbiased. Okay, covered members. So this is a very important group of people. I'm gonna capitalize that. And they are held to a higher standard of independence than other professional staff in the CPA firm. Okay, the question comes up, you know, let's say we're auditing IBM. Who has to be independent? Does everybody in the firm have to be independent? You know, does the, you know, which managers and auditors, and, you know, does the janitor have to be independent? Does the secretary have to be independent? You know, who has to be independent when we're talking about doing an audit? And they came up with the idea of covered members. In other words, they're covered by this these restrictions that they have on independence. So, you know, who is a covered member? And you have to, and covered members are held to a higher degree of responsibility. So there's sort of like two different types of rules. There's rules for covered members, and then there's rules for everybody else. All right, so covered member rules, and these are probably the most important rules. These are for people that are directly related to the audit for the most part. Okay. So in the audit firm, who is a covered member? Well, anyone who's on the audit itself. So the audit engagement team. So everybody who's on it, if they're a partner, a manager, a senior, associate, you are a covered member. So obviously, if you are on the audit, you must be independent, right? And that's probably the most obvious one. Now, in the engagement office, every partner in the engagement office, so the office that they do the there we go. So in the engagement office, every partner in the engagement office must also be independent. And these are probably the most important ones on there. These are the people that usually it comes up if there's a problem with independence, it's usually in this group. So anyone who's on the audit, obviously, and any partner in the office that does the audit. So if this is the Chicago office, any partner in the Chicago office must be independent from, say, IBM, if they're doing the IBM audit. Now, if you're in a different office, if you're in the St. Louis office and a partner, that doesn't apply to you. But if you're in the Chicago office, the office is doing the engagement, it applies to you. You must be independent. You're held up to a higher standard. Okay, non-attest services. This could be the same office or a different one. And these are usually consulting people. So non-attest services would be things like doing taxes, that sort of thing. And these are non-attest things. So in other words, they're not, you're not putting your stamp of approval. It's not an audit. It's not a review. They're consulting, basically. Okay. Those people working on the non-attest services for the client. The partner and the manager. These are often called 10-hour people, just to make them mad. No, they're called 10-hour people because it's only required if they perform 10 hours or more of services in a year. So in other words, if it's something, if it's something trivial, someone calls up a partner and asks about a certain tax issue, the partner takes a couple hours and figures it out and sends them back. That's not going to make that partner, any problems with independence. It isn't like that 2 hours of service is going to, endear that partner to the client to such an extent that, is going to affect the independence. So when you hear 10-hour people, these are people that are not on the audit. They're managers and partners who are doing basically consulting work. And these three categories, so this is, let me do this a little differently. This is, A, you're on the audit team. B, you're a partner in the audit office. Or C, you're doing consulting. These are the three main categories of people who are covered members, and they are held to a higher standard of independence. Notice these other people, this manager is not a covered member. The covered member rules do not apply to manager 1. They don't apply to manager 2 or manager 4. Right. Down here, the senior on the attest services, if they have a senior doing taxes, they are not a covered member. So these are the covered members, and these are the only ones from these offices that are the covered members. Okay, coming down here, there's actually 3 more groups that are covered members. Anyone who is in a position to influence the audit. So it could be a senior partner, it could be a partner reviewing. If a partner comes in from out of town to review the audit, they would be a covered member. They'd have to be independent. So anyone who's in a position to influence the audit is also considered a covered member, and it could be anybody. It's usually talking about upper level people, and they're usually there for, say, reviewing the audit. Those are also going to be people that are covered members. The CPA firm itself. So if we're auditing IBM, the CPA firm can even, if, let's say they have a benefit plan, a pension plan or something, they cannot buy IBM stock. So the CPA firm itself is a covered member. So, anything that that applies to covered members applies to the CPA firm also. And here, this one's kind of a catch-all thing. Any entity that is controlled by covered members. It doesn't have to be controlled by one covered member. It can be controlled by many, but if they have more than 50% control, that entity is a covered member. So you can't have, say, 3 covered members pool their money together, make an investment fund, and buy IBM stock. You know, if that's controlled by covered members. You say, well, any member, no one member controls it, but in total they do. Now, if you have a covered member that has a 40% interest in an investment company, and if they don't make any of the decisions for buying the stock and the company buys IBM stock, that's fine. They don't control it. So, you know, any entity that's controlled by covered members, though, is also considered a covered member. Okay. So, first thing we're going to look at are independence and for financial interests. So these are like investments, basically. Covered members may not have any direct financial interest in the client. They can't own one share of stock. So if you are a covered member, you cannot own one share of IBM stock. You're auditing IBM, you can't have one share. You say, well, who cares? It's one share. It's not going to make it. You can't have it. You can't have one share of IBM stock. Indirect financial interest. Covered members may have indirect financial interests in the client if the financial interest is immaterial.
What does indirect financial interest mean?
It means, for example, let's say that there's a Standard & Poor's 500 fund. It's what Poor's. I don't know. So Standard & Poor's 500 has the top 500 companies It could be other things too. So let's say that they have, is that how you spell it? You know what's sad? My stepson works for Standard & Poor's. I should know how to spell it. Okay, if you guys ever meet my stepson, we're gonna forget that this happened. So Standard & Poor's 500 fund. So they take the 500 biggest companies. All right. Now, if we're let's say IBM is one of them, you know, is that material? It's indirect. You know, you're buying into the fund. The fund is then buying the stock. But if IBM is one of those 500 companies, it's only 1 in 500. So this probably not going to be, you know, that's definitely going to be immaterial. So that would be indirect. It'd be so you can invest in a Standard & Poor's 500 fund and not have any problems with it. This is not going to be material. Now, if you're investing in a tech fund, and the tech fund is is 40% IBM, that's probably material, and you probably have a problem with it. So it has to be indirect and immaterial. It has to be both. So Standard & Poor's 500 for another stick. Another example would be investing in the bank. So we invest in Bank of America. Bank of America loans money to IBM. That's indirect. And as long as that investment is not material, and when we're talking about the investment, we're talking about the amount of money that Bank of America has in IBM, how much of it is tied up in there. It very likely isn't material. So if you invest in the bank and the bank loans money or it does some services for IBM or whatever, that's another indirect way of investing. And again, it has to be indirect and immaterial. Okay, now here's the new thing for tonight that I'm hoping maybe I'll start doing this in all my classes. Is we actually will see, we'll actually answer these questions and I'll record them. So I'm going to give a poll. Now these polls are not anonymous. Why? Because I'm going to use these to I'm going to use these polls to basically to check in your assignments. This one's going to be a little bit different in that they actually later on it goes back down to regular write-in stuff. But I'm hoping, well, I'll see how this goes. If this is a complete disaster, you'll never see it again. But so we'll go through each of these and anyway, we'll discuss them. Since we're in class right now, we'll go ahead and discuss them and see what the decision is. So on the poll, I just did I share that with everybody? Did you guys get the poll thing or no?
Yeah, it's a pop-up on the other window.
Okay. All right. So let's see. Gina is a member of the audit engagement for IBM. She owns 5 shares of IBM stock. This ownership is immaterial to Gina. Okay, so is Gina a covered member?
Yes.
Yep.
This is a direct interest.
Yep, direct interest. And it's immaterial, but that doesn't really matter. Is Gina in violation of the independence rule?
Yes.
Yep.
So on the multiple choice, this is our way of keeping track of that we were here tonight.
Yeah, we might, a way of kind of, and hopefully, again, this is kind of putting it more into scenarios. Hopefully it makes it a little more real than just reading the stuff.
So I have a question with the polls. Do we enter, like it says question 1 and then it has like A, B, C, D, or E?
Yeah, so for instance, question 1, just put it, since we're kind of talking about this right now, this would be yes. So you just put A for number 1. If it was no, then you put B in and ignore the rest of the letters. So all these are going to be A or B, basically. So number
Okay.
1, yeah, number 1 be A. Okay, how about number 2? Greg is a member of the audit engagement for IBM. He has investment in a standard. I don't know why I have Standard & Poor's 500 mutual fund. Because IBM is in the Standard & Poor's 500, the mutual fund has a direct interest in IBM. Okay, Greg, covered member?
Yes.
Yes.
Covered member. Direct or indirect interest?
Indirect.
Indirect?
Yep. And material or immaterial?
Immaterial.
Material.
One of 500 companies. Is he in violation? Nope. No, so if as long as it's indirect and immaterial, it's fine. Now, this is one of those things that you'll see on the CPA exam, they'll kind of throw people. It says the mutual fund has a direct interest in IBM, which is absolutely true. But Greg doesn't have a direct interest. The mutual fund does have a direct interest. The mutual fund is buying IBM stock. So the mutual fund has direct interest. Greg does not. Okay. Helen is not a member of the audit engagement for IBM. However, she's a senior auditor in the engagement office. She owns 500 shares of IBM stock. This investment is material to Helen. Is Helen in violation of the rule? Okay, so is Helen a covered member?
No.
No.
No, yeah. She's the engagement office. So Helen, who was she? A senior or a manager? ADD, senior auditor. Okay, so it'd be like if she was this. If this is Helen, she's not a covered member. Oops, flew past Helen. Okay, so not a covered member. Direct interest or indirect?
Direct.
Direct. And material or immaterial? It says a material to her, so it'll be material. Is Helen in violation of the independence rules?
No.
Nope.
No.
Not a covered member. So if she's not a covered member, she can own IBM stock. Okay. Independence, interest of immediate family members of covered member. Okay. I don't know, see if I wrote it. Immediate family members who own stock and client, also cause conflicts of interest, covered member. Okay, immediate family. The immediate family of family members are considered the same as the covered member. Now, the question is, well, who are the immediate family members? They are spouses, spousal equivalents. Okay. Dependent children. Those are basically the family members, and they are considered to be the same as
That because they could just buy stock in their names.
Yeah, okay, I won't buy stock in I'll have my wife buy it, or I'll have my husband buy it, or I'll give it to my kid. You know, I know I'll give my stock to my kid. That's a no-no. So spouses, spousal equivalent, and dependent children. Now, notice that this is dependent children, not independent children. So it's basically the people that you know, when you go home at night, who's there? You know, I mean, that's kind of what we're such a big numbers. You know, who's there? That's the immediate family, and they are considered to be the same as the covered member. Okay, Sharon, a member of the audit team. She does not own any shares of IBM stock, but her husband owns 10,000 shares of IBM stock. Okay. Covered member or not covered?
Covered.
Covered.
Yep, covered.
Correct.
Immediate family members are covered members. Direct or indirect?
Yeah.
Direct. And,
Yeah, I'm here.
and immaterial or material and immaterial, probably material. I got to think of 10,000 shares of IBM stock. Immaterial, $1 million or something. But quite honestly, even if it was immaterial, it wouldn't matter. Covered member, direct interest is in violation of the rules. Yes.
Yes.
Hey, come on. There we go. And quite, you know, like I said, materiality really doesn't matter in this case. Even one share. Okay. Steve is a member of the audit engagement for IBM. He not only shares of IBM stock, but his daughter owns an immaterial amount of IBM stock. Okay. Covered member or not covered? It really depends on this. This one's a little bit open. I probably should have made this a little more defined. But so it's his daughter. If she's a dependent, it'd be a covered member. It's direct, immaterial. Violation of the rules, yes. So it really depends on, you know, whether the daughter is dependent or not. If she is dependent, she's a covered member, it's a direct interest. Immaterial, but that makes no difference because if it's covered member, indirect. And if it was a non-dependent child, not a covered member, direct, there wouldn't be a problem. I actually get into this a little bit more later on. I should say that this is his dependent daughter. Okay. Jolene is a member of the, she does not own any shares of IBM stock, but her husband has a large investment in technology fund. 40% of technology funds holdings are in IBM stock. Okay, covered member or not?
Covered.
Yep, covered member. Direct interest or indirect?
I think direct.
I think isn't it indirect because it could be like a ETF or some other. When we say fund, we're sort of saying the mutual fund or whatever.
Yeah, it's indirect. However, material or immaterial? And it goes by the basis of the investment itself. So this is probably material. You know, 40% of the fund is IBM stock. So it's most likely material because, like I say, when you buy that, when you invest in that technology fund, you know that 40% of it is going into IBM. So it's more likely going to be material. And in violation of rules, yes,
Yes.
because it's an indirect interest. It has to be indirect and immaterial. So the Standard & Poor's 500 fund is fine. It's one of 500. This one is probably material in relationship to the investment itself, 40% of it. So because it's material, and the independent rules are violated. If you think about it, 40% of it is in that technology fund. Whatever IBM does probably has a big impact on what that technology fund does. Okay. I'm hoping to do more of these kind of things, though, these kind of polling things. Hopefully it'll, I don't know. Hopefully it'll help. Close relatives and friends. Okay. Close relatives and friends. These will be non-dependent children. Siblings, so your brothers and sisters. And parents. And obviously, the one here that is sometimes overlooked is friends. So, friends that you have would also be in there. And that one can be a little bit tricky. And the reason I say that is a lot of times at the upper levels, the partners are sort of considered friends of people in the business. It wouldn't be unusual at all for the partners who play golf with, people higher up in the client, in the client's organization. So it can be a little bit tricky when you talk about friends, like who's a friend and how close they are and all that kind of stuff. Okay, now there are some kind of strange rules for this. Okay, so they may have one. An immaterial financial interest. I should say immaterial direct financial interest. And here is the strange one, like bugs people. So they can have an immaterial direct financial interest. So, and the materiality is to whoever owns the stock. So, whichever one of these people own the stock, it's immaterial to them. And so it could very well be, that different amounts of stock are material to different people depending on their finances. And this one, a material direct financial interest, material, if it is unknown to the covered member. In other words, you don't know about it. So, you know, you're covered member and your mom owns $180,000 worth of IBM stock, but you don't know about it. That's fine. The question becomes, well, how do you prove the negative? How do you prove you don't know about it? You know, and so it, you know, if that were to ever come to light. But you gotta remember too, you know, let's talk about siblings. You'll find, you know, brothers that haven't talked to each other for 30 years. And whatever they own in the stock, well, they have no idea, don't care. You know, so it becomes a little bit tricky when you're talking about these, even though they're considered close relatives, they may not really be all that close. But anyway, an immaterial direct financial interest is okay. A material direct financial interest is okay if it's unknown to the covered member. And if you think about it, it's unknown to them, you know, they have no you know, whatever, you know, it wouldn't have any impact on them. But again, that would be a hard one to prove. You know, how do you prove the negative? You can't, it's not like you can show pictures. See, this is me not knowing that my mom had stock or whatever. Okay. So one is a member of the audit engagement. She does not own any stock in IBM stock, but knows that her sister owns 500 shares. IBM stock investment is immaterial to her. Okay. So is her sister a covered member? No. These are close relatives and friends. They're not considered covered members. Let's write that down. If they're covered members, they'd have been in the first group. So these are not covered members. That's actually an important one. I should have I should put that in earlier. So these are not covered members. They might still have a problem with independence, but they are not considered covered members. Immediate family, covered members. Not immediate family, friends, close relatives and friends are not covered members. However, there's kind of rules that relate to them. And for obvious reasons, you know, if your parents have IBM stock, you know, you're probably, you know, you may inherit it or whatever. So, you know, it would be sort of like a, at some point in time, it could be your stock. Okay. So Wanda, a member of the engaged team. She doesn't only stock, but knows that her sister, who's not a covered member, oops, and doesn't like being green, owns 500 shares. The stock is immaterial to her sister. Okay, so to her sister, is this a direct interest? Yes. And it is immaterial. So is Wanda in violation of the independence rules?
No.
Nope. It's direct financial interest, but it's immaterial. And again, this is, you know, it's in you're talking about materiality to whoever owns it, not to the auditor. It's not the auditor's stock. If the auditor owns it, it's, you know, anything is a no-no. Okay. Stacy is a member of the audit engagement for IBM. She's not on any shares of IBM stock, but knows that her brother owns 300 shares. The IBM stock is material to her brother. Okay, her brother is not a covered member. It's a direct interest. And to her brother, it is material. So is Stacy in violation? What do you think? Oh, come on. You guys are toying with me. Okay, I'm going to talk about the rock that I found. I found this rock. I think it might be a meteor. It's metallic. Actually, magnet sticks to it. I found this on the ground. So,
It is yes.
yep.
Because
Notice
he knows it. Or she knows it.
she knows about it. Yeah, she knows about it. And notice that
material.
even though it's, the number of shares, for this one, 500 shares was immaterial. For this one, depending on their financial situation, it could be material. If it is material to them, then you're in violation.
I mean, this assumes that you're not engaging in any insider trading or you're telling any information, like you're keeping all the confidences of your engagement anyways, right? Like that
Right,
goes without saying.
right. And, and two, notice that, it could be that someone wants to help out, Stacy wants to help out her brother. That's not an unusual thing. So, yeah, it could have some independence problems because of that. But yeah, it could be insider trading too. You're absolutely right. Okay, Lawrence is a member of an engagement. He does not own any shares of IBM stock, but his father has a material investment in IBM stock. Lawrence does not know about his father's investment. Okay, not a covered member. Direct interest. Material. Is Lawrence in violation? Nope. Doesn't know about it. So the difference between these two, if you look at the actual kind of chart we did, not a covered member, direct interest material, not a covered member, direct interest material, because Lawrence doesn't know about it, it's not in violation of the rules. If you think about it, if they don't know about it, they're not going to act upon it, right? I mean, if you don't know it, they're not going to act upon it. Again, would that be hard to prove? Yeah, it's impossible to prove, to prove the negative. So it's like me saying that I have supernatural powers, I can, whatever, I can, shape, shape shift or whatever. Prove that I can. All right. May is a member of the audit engagement for IBM. She is not on any shares of stock, but her mother has a material investment in IBM. May knows about the investment and asks her mother to sell it. Her mother refuses to sell the IBM stock. What a great mom. All right. Again, not a covered member. Direct interest, material. She knows about it. Is May in violation?
Yes.
Yes. And this one is a little bit tricky one. There's actually been lawsuits on these that because this could possibly be someone taking away their ability to make a livelihood. May, through no fault of her own, is being prohibited from doing an audit because of something somebody else is doing. So I'm not sure exactly how the law works out on all this, but I know that there have been lawsuits about this very situation where you have people who, parents. She should move back into her mother's basement. That'll teach her. Play loud music. Okay, so let's see the poll. So this is that's 1 through 10, right?
Yep.
Okay. Are people still putting it in? I'm going to close the poll here in a little bit. Okay. aside for now. Okay. Independent employee interest in covered member. Employee interest, employment interest, excuse me. What time is it? I guess it does get a little late here. Employment interest of covered members. Okay, so this is employment, and it can go one of two ways. It can go from the client to the CPA firm, and that's what this first one is. That's very rare. So I go from the client, say IBM, to the CPA firm. That doesn't happen very often. Or it can go from the CPA firm to the client. That's much more common to have happen. So the first one here is not very common. You usually don't get employees going from your client to the CPA firm for just a number of reasons. CPA firms have their own ways of getting people, and furthermore, you wouldn't want to steal employees from the client. That's not going to, endear you to them. So, employee gets hired by a CPA firm. There's not a problem with that. Oops. The new CPA firm employee cannot be part of the audit of an audit. Okay, they cannot be a part of an audit that includes their prior work for the client. All right, what I mean by that is that it does a terrible sentence, but what I mean by that is that, so for instance, someone came from IBM. Let's say that they were in the accounting department, and they come over to the CPA firm. Now, it might be natural to think, okay, well, in the CPA firm, right? I mean, hey, when we do the IBM audit, you'll know everything about IBM. We'll take you to the IBM audit. There's a problem with that. They could be auditing their own work. If they were in the accounting department at IBM, they could be auditing their own work. So they cannot be a part of an audit that includes their work that they performed for the client. They'd be auditing themselves, basically. Now, if time goes on and no longer is their work part of the audit, then they can. A couple of years go by and whatever they worked on, whatever Ant and all that wasn't in there, they can then be on the audit. But they can't be on the audit if it includes if the audit includes any of the work that they performed. And again, that might be, it might seem like an obvious thing that if they work for IBM, you say, okay, well, they know more than IBM than anyone else in the place, but they can't work on it. Okay, let's see, the polls are in. Oh, polls are in. Okay, so I'm going to end polling. And I'm going to download it. And get rid of it. Okay. Hey, what am I? I'm on a blank screen here. Okay. All right. Oh, we need a new poll. It's not letting me end the polling. Oh, maybe I do share results. Okay, let me just jump to, okay,
Oh, yeah.
you got it? Okay, all right. Sorry about that. Oh, what the heck am I on? Okay. Gracie worked at IBM in the accounting department. She was recently laid off from her position. Took at IBM auditors. Can Gracie participate in IBM audit? What do you-
No.
No. Nope. Okay. Employee gets hired by, what time is it? Yeah, well, we'll finish these. We'll do these two, and then we'll call it night. All right. We'll do this page, I should say. Okay. So employee gets hired by the client. This is very common. If they let you go out of the CPA firm, they try to get you a job with the client. A couple of clients said, look, we get the senior auditor. We don't have a spot for her to move up. But really good. You guys have anything done? Yeah, send her over. Yeah. So this is a very common thing. Okay. So the client is a non-issuer. If the CPA employee accepts or is still considering the employment offer, it must be removed from the audit. Okay. So if the employee accepts or is still considering the employment offer, they must be removed from the audit of the client. So IBM gives someone an offer and they accept it. If they accept the offer, they must be taken off the audit because they're now working, or they will be working for the client. Or if they're still considering the offer, they must be taken off. So if they haven't refused the offer, basically, they must be taken off the audit. Now, if they refused it, IBM offered them that they're not interested, that's not a problem. They can still be on the audit. But if they have accepted the offer, or if they are still considering the offer, then they must be taken off of the audit because they're not independent. Now, the client is an issuer. There's going to be two things that happen here. Same as above. Oops. Oops. So same as above for the non-issuer taken off the audit. So if it's a publicly traded company, you still got to take it off the audit. If you're considering it, or excuse me, if you accept it, or if you're still considering it. There is another kind of an odd rule that I'm surprised still stands, but it does. And that is if the employment offer is for a key financial position. Uh, it's basically, usually it's, I shouldn't say it's 1 year. A lot of times it's more than a year. So clean this up a little bit. This could end up being almost 2 years. Here's the problem they used to have. A lot of times, if there was a manager that would leave a CPA firm, they would become a controller of one of the clients. So here you have a manager who maybe has trained the seniors and the associates, and that they become the controller of IBM. So they go in for an audit, and who are they facing? They're facing the person that taught them auditing. That's who they're facing as the new controller of IBM. That was felt that that was not a good thing. So if it's a key financial position, again, it has to be a key financial position. If it's a key financial position with the client, the CPA employee must wait for an entire audit cycle before taking a position. What they mean by that is, so for instance, let's say that I was on the audit in 2000, let's say they gave me this offer in March of 2020. At the end of 2020, it hasn't been an entire audit cycle that I was off the audit. So if they offered it to me in March of 2020, I couldn't take that position until January 1st of 2022. Because I should be off for an entire audit cycle, which would be the 2021 year. So you have to be off for an entire audit cycle before you can take it, a key position. Now they can give you a position that's not a key position. You mean an analyst position or something like that. If they hire you, and a lot of times, for the lower levels, if they hire you as they say, a staff accountant or accounting supervisor or something like that, that's not a key position. You can take it right away. But if it's a key position, you have to be out for the entire audit cycle. Now, if they're planning on giving it to you, you may, if they plan ahead, you can work it out so that you're off it for an entire year, work on other audits or something like that. But they must be off the audit for an entire audit cycle. Interesting thing about this is from the PCAOB. The onus is not on the CPA firm, it's on the client. So if this is, it's that IBM cannot hire anyone who was on the audit within the last year into a key position. So, it's kind of interesting who this rule applies to is not the audit firm. It's not the auditor. It applies to the clients. Okay. Okay, I'm sorry guys, that was a little late. Okay, so cases, issuer. Sam was a member of the IBM audit engagement team. He has been offered a job at IBM. Sam has not accepted or rejected the IBM offer. Can Sam work on the IBM audit?
No.
Nope. If he's not rejected it, cannot stay on it. Even though it's a publicly traded company, the same rules apply. They must be taken off the audit. George is a member of the IBM audit team. He has recently got a job offer from IBM. The job is for a staff accountant. Can George immediately accept the job offer?
Yes.
Yep, not a key position. Lisa is a member of the IBM audit engagement team. She recently got a job offer from IBM. The job is for the controller position. She immediately accepted the job offer. What do you think? Controller? That's a key position, key financial position. Can she immediately accept the offer? No. Has to be off the audit for an entire year. No, I should say an entire audit cycle. It could be almost up to 2 years, depending on when the job offer was. And by the way, these rules aren't surprising to companies anymore. So it's not like you're gonna surprise somebody. Everyone knows what the rules are. Okay, Mickey's a member of the GeoCorp audit engagement team. GeoCorp is a privately held company. She just got a job offer from GeoCorp as their chief financial officer. Can Mickey accept the job offer? Okay, this is a non-issuer. There is no key position rules for that. Yep. So if it's publicly traded, key position comes into play. It's a key position, you gotta be off it or if it's a non-issuer, no problem. If you think about it, a lot of times non-issuers are smaller companies. If they take you out of a CPA firm, it probably is going to be a pretty key position. It's not going to be unusual at all. So anyway, so that is a difference between those two. So non-issuer, you can take it. Okay, I'm gonna say stop here. So we have what 1 through 5 on this one.
Mm-hmm.
So go ahead and submit that.
Oh no, they got us going to question 20, so it doesn't allow us to submit.
Oh, just hit. I forget what it's called.
There's no question.
Yeah, no question exists. Actually, yeah. Put no question exists for 6 through. No, for 16 through 20. So 16 through 20, just click on question does not exist or what I can't remember how I worded it. But yeah, if you just click on that on those for those 5. Let's see. Hey, I got everybody. It's weird. It's not letting me quit the poll in this. What's going on here? Oh. I can't do it twice. My other classes, it gave a thing, exit the poll, and it's not not giving me that option here. Oh well, I downloaded the results. Okay, so we'll stop here. So next week we will pick up there, and I will get a test out tomorrow on the internal control stuff, and it'll come basically out of the handout stuff we covered in the handout. If there's questions on it, feel free to contact me. We can go over any of the stuff. Part of the reason why I'm starting to do this multiple choice thing is I think it'll more quickly get us through, and if I hone these in a little bit better, they will. It'll be a better way of delivering it. That's all. So anyway, we will.
You haven't graded the last test yet, have you?
I have not. It's due tonight, I think, isn't it? I think I have it due on the 21st.
Yeah, it's due tonight.
Yeah, yeah. And so, yeah, I will, oops. I will put that, I'll put the grades through in that when they're entered in here. But anyway, yeah, so those should be in there fairly shortly too. And by the way, if you're missing any work, turn it in. There is no penalty for turning it in late. So there's no reason not to. And we're down to there's only 2 more classes after this one. So next class we'll kind of wrap up most of the stuff, and then we should have a test on this stuff. That'll be our last test basically. But anyway, turn it, if you're missing anything, turn it in. There's no reason not to. You'll get full credit for it. Any questions? Okay, so if you have not turned in the sampling test, make sure you get that in. And I will be sending out this test probably by tomorrow. I'll try to get it out tonight, but certainly by tomorrow I'll get it out. Okay, well, I will see you guys next week. And hopefully my head will be healed by then. Okay, guys, have a good evening.
Good night.
Good night.
Good night.
Thank you.